So, welcome back to the classes again. So, this is our third part of Index 115. So, in this third part, we have completed 20 questions already. Now we are starting from 21st one. So, here the entity enters into 1,000 contracts with customers. Okay, each contract includes a sale of one product for 50 rupees each. Like 1,000 into 50, it's like that. 1,000 into 50, it is 50,000 is the total consideration. Now here the cash will be received when the control of the product is transferred. When control transfers, cash will be received. And here the entity's customary business practices is to allow a customer, that is the customer can return the unused product any day, like within 30 days, and he can receive the full refund as well. And here the entity's cost of each product is 30 rupees. Here the entity applies the requirements of Ind AS 115 to the portfolio of 1,000 contracts because it reasonably expects that in accordance with this Ind AS 115, that is revenue from contract with customers. I'm not reading paras because paras is generally we don't remember in exam. So all that we need to remember is, yes, this question is from Ind AS 115 and that's revenue from contract with customers. And in accordance with that Ind AS, the effects of the financial statements from applying these requirements to the portfolio would not differ materially from applying the requirements to the individual contracts within the portfolio. So here that is the question. So here, since the contract is allowing a customer to return the product, here since the contract is allowing the customer to return, what happened, the consideration that is received from the customer is variable because he is having a right to return. He may or may not return, it is a variability. So here, to estimate the variable consideration to which the entity will be entitled, the entity decides to use the expected value method. What is the method the entity decided? Expected value method. That is, you have more than one outcome because it is the method that the entity expects, that that expects to better predict the amount of consideration to which it will be entitled. Okay, using the expected value method, the entity is estimating that 970 products will not be returned. That is, 30 products will be returned. So here, how can you say that first how many products that he sold? He sold 1,000 products, but how many will not be returned? 970. So 970 into 50, that you can recognize as a revenue. And the second thing is how many will be returned? 30 products, 30 items will be returned, and that 30 products, what is the cost? What is your cost of making it? 30 rupees. As we have discussed before, it is 30 rupees per product. So that will be your asset, 30 rupees, because you're going to return, you're going to receive it during the return. You're going to receive that 30 products into 30 rupees during the return. Your cost is coming back, so you'll recognize it asset. And apart from that, there is something called liability, because when the person is returning, you need to pay him. How much you need to pay? 50 rupees only, because we discussed that 50 rupees only should be paid. So here the entity estimates that the cost of recovering the products will be immaterial and expects that the returned products can be sold at a profit. So now determine the amount of revenue, refund liability, and the asset that is to be recognized by the entity for the set contracts. So what is the amount of revenue, refund liability? So just now we discussed. So first you have to write the entity should consider the requirements of Ind AS 115, that is revenue from contracts with customers. Sorry, first what you have to write is this: the entities should consider 115. Okay. 115 on estimates of variable consideration to determine whether the estimated amount of variable consideration, that is 970 into 50 rupees per unit, okay, which is not expected to be refunded, whether this consideration can be included in the transaction price or not. You have to determine first whether there is any variability in recognizing it. You have to determine. And second thing, the entity should also consider the various factors that is given in Ind AS 115, that is revenue from contract with customer, and he should determine that although the returns are outside the entity's influence, that is, it is not in entity's hands whether the customers are going to return them or not, but although it is outside the entity's influence, it is significant experience, it is having a significant experience in estimating the returns for this product, and the customer class. So in addition, the uncertainty will be resolved within the short uncertainty will be resolved within a short time frame, that is within 30-day return period. Thus, the entity concludes that it is highly probable that a significant reversal in the cumulative amount of the revenue recognized will not occur as the uncertainty is resolved. That is, after the reporting period, after the uncertainty is resolved, a cumulative reversal will not occur. Until that, the entity can conclude the entity is highly probable. Now, here the entity is also estimating that the cost for recovering the product will be material, because they'll come and return the product. You need not go and recover. So there is no cost of recovery also. And he's also expecting that the returned products can be resold at a profit. Okay, within that period of return, within 30-day return period, you can again sell them back for the same profit of 20 rupees, if I'm not wrong. Now here, upon the transfer of the control of this 1,000 products, the entity does not recognize the revenue for the 30 products that it expects to be returned. Consequently, in accordance with this in days 115, you have to recognize revenue of 48,500. That I said 15 to 950. Next, revenue liability of 15 to 30, that is 1500, and asset of 13 to 30, because the asset is going to be returned to you. Your asset, I mean, your product is going to be returned to you and you're going to receive it in future. That is an asset. And next question number 22. Here, an entity is entering into a contract with a customer to provide a weekly service for 1 year. So he is giving, entity is giving a weekly service to a customer. For what? The contract is signed on 1st April and the work began. Now here, the entity concludes that the service is a single performance obligation. What the entity is concluding, that the service, whatever the service the entity is providing to a customer, that is a single performance obligation. So this is because the entity is providing a series of distinct services, because it is a series of services all together he have to provide. That's why he is considering it as a single performance obligation altogether, integrating. So here, and it has a same pattern of transfer also, that is the services transfer to the customer over time and use the same method of measure progress also, same method to measure the progress also. So this is a time based measure of progress, you can say. So in exchange for the service that is given by the entity, what the customer is promising to give 100 equity shares. That is, he's not paying cash, but he is giving equity shares for every week of service, like 100 equity shares into, generally we have how many weeks, 52 weeks in a year. So 100 equity shares into 52 weeks, 5200 shares for the contract. Here the term in the contract require that the shares must be paid upon the successful completion of each week of service. What the terms in the contract require, it requires that the shares, whatever the shares are there, they must be paid upon the successful completion of each week of service. Now, how you will decide a transaction price, because your fair value whatever is there, it keeps on changing. I can say that here 100 equity shares whatever is there, it will be recorded a fair value upon the completion of each weekly service, and you need not reflect any subsequent changes in the fair value of shares thereafter. If in future the share value of shares are changing, you need not reflect any subsequent changes that happen. That is, you take fair value as on the date of issuing the shares, that is on the date upon completion of a weekly service. Then only you'll give shares, right? So here the entity measures its progress towards, answer goes like this: it is measuring its progress towards complete satisfaction of a performance obligation as each week of service is complete. To determine the transaction price, to determine the transaction price and the amount of the revenue to be recognized, the entity has to measure the fair value of 100 shares that is received upon completion of each weekly service. What it is doing, the entity is measuring the fair value of 100 shares, first of all, okay, that are received upon the completion of weekly service. Here, the entity should reflect any subsequent changes in the fair value of the shares received in revenue. The entity shall not reflect, sorry, it's like entity should not reflect, okay, any subsequent changes need not. Next question is 23rd. In this, One second. Yeah, in 23rd question, RT Limited is entering into a contract to build a office building. Office building for AT Limited over an 18-month period. So over an 18-month period, it is RT is entering into a contract with AT. Okay, here RT is a contractor, let's say. Now AT is a customer, like he wants construction. For that construction service, this AT Limited is paying 350 crores for the project. 350 crores. Now, RT Limited will receive a bonus of 10 lakh equity shares. Okay, 10 lakh equity shares. Like AT Limited is giving 350 crores for the project, plus also is giving 10 lakh equity shares if it completes the construction of the office building within 1 year. Within 1 year, 10 lakh equity shares. Now assume that the fair value of that 10 lakh, one share is 100 rupees at the contract inception. So I can say what is the total 10 lakhs into 100 rupees? That is 10 crore, right? After that, 10 crore plus 350 crore in cash. The whole transaction price will be 360 crores. Let's go to the answer. The ultimate value of the shares the entity might receive could change for two reasons. What are the two reasons? The first one is the entity earns or does not earn the share. He may or may not earn the share. And the second is the fair value price per share. Whatever is there, it may change during the contract term. So this is the second one. So when determining the transaction price, the entity should reflect the changes in the number of shares to be earned. First, excuse me. First, when determining the transaction price, when you're determining the transaction price, the entity should reflect the changes in the number of shares to be earned. How many shares I'll be earning? So you should first um, make up your mind about it. Next, however, the entity would not reflect any changes in the fair value per share thereafter. So once the shares are issued, thereafter you need not make any changes for that. Now, said another way, you can say it another way, how the share price of 100 rupees is used to value the potential bonus throughout the life of the contract. You can say that it's like a bonus, 100 rupees. Now, as a result, if the entity earns bonus, it would be its revenue would be 350 plus 10. 350 crores plus 10 crores. That is 360 crores. That's all about 23rd question. Now 24th is Q Limited is entering, Q Limited has realized an advertisement in Deshbandhu. In Deshbandhu, it's a vernacular newspaper. It's a vernacular daily. It's a newspaper. So instead of paying for the same, what happened? Q Limited allowed the Deshbandhu free advertisement spot. So it's like exchanging of services, okay, which was duly utilized by Deshbandhu. Now, however, revenue for these non-monetary transactions in area of advertising will be recognized and measured. How will this be recognized? So as per India is 115. So it's simple. Advertisement in newspaper, Deshbandhu is a newspaper, okay. It wants advertise um it will give advertisement in newspaper. Now advertisement spot in QTV. QTV, it will give advertisement. Deshbandhu will give advertisement in newspaper to QTV, and what QTV will do? QTV will give advertisement spot in its TV ad to Deshbandhu newspaper. Okay. Now here you can say these both are different modes of media, even though they are communication media only, but still it's a paper and that's a TV. So now, as per Ind AS 115, this Ind AS 115 revenue from contracts with customers, in this Ind AS 115, it is excluding. This 115 will exclude the non-monetary exchanges. All non-monetary exchanges, no. Only when they are in the same line of business. Okay, it excludes the non-monetary exchanges between the entities in the same line of the business to facilitate what? To facilitate the sales to its customers, potential customers. Here, for example, this standard will not apply to the contract between two oil companies. Two oil companies, like they both are oil companies only. Okay, to satisfy the demand of the customer. Hmm. Might these oil companies might two oil companies. What happened? See, This standard, this is just an example. Two oil companies might have agreed to exchange the oil to fulfill the demand of the customers, okay, in different locations on timely basis. So here in industries where the homogeneous product, in some industries which have homogeneous product, it is very common for the entities, it is very common for the entities in the same line of business to exchange the products in order to sell them to the customer. It is very what it is very common. See, for homogeneous products like oil selling oil only, it is common, both are oil companies only, it is common for those type of entities in same line of business, okay, to exchange the products in order to sell them to the customers or potential customers, because oil won't change other than the parties to the exchange. Now here current scenario, if we see, if we go ahead and see this current scenario, the current scenario on the contract, on the contrary, will be covered under Ind AS 115. How? Since the same is exchange of dissimilar goods and services, because both of the entities deal in the different mode, okay, different mode, different media, whatever you can say, both are dealing with different, sorry, yeah, mm, both are dealing with different mode of media. That is, one will be a print media and the other will be the electronic media, and both parties are acting as a customers and suppliers for each other. Now, if you go ahead and see the current scenario, it seems that the consumption by the said parties, okay, why they are consuming? The consumption is not to facilitate sale to the customers. Okay, while why they are consuming, it is not to facilitate sale. For example, here oil companies will exchange, why, to facilitate the sale for its potential customers. But here, this ad agency company and this newspaper company, they are exchanging not to facilitate the sales. Okay, which will not fall under this Ind AS 115, which is not exempted to be, which is I mean, which is not included, which will not fall under that criteria to determine the transaction price. So here, uh, it may also be noted that, sorry, it may also be noted that after that, even if it was to facilitate the facilitate sales to the customers or potential customers, it would not be scoped out. It would not be scoped out since the parties are not in the same line of business. Next, in days 115, the entity shall consider the terms of the contract. What the entity will do, it will consider the terms of the contract and customary business practices to determine the transaction price. So here the transaction price is the amount of consideration to which the entity expects to be entitled in exchange for transferring promised goods or service to the customer, excluding the amounts collected on behalf of the third parties. So here the consideration that is promised in the contract with the customer may include both. I mean, it may include the fixed amounts and fixed amounts, variable amounts, or both. So again, in this 115 provides that to determine the transaction price, in order to determine the transaction price for the contracts in which the customer promises consideration in a form other than cash, then the entity shall measure the non-cash consideration, or non-cash consideration at how much fair value. It will measure the non-cash consideration at fair value. Okay. Next question. So yeah, here what the conclusion will be: in accordance with that, QTV and Deshbandhu should measure the revenue promised in the form of non-cash consideration as per Ind AS 115. And the next question is also the same. Here, as we have one print media and one advertisement, TV. Here, second, another example is telecommunication company and other one is power supply company. They both exchange, again they are not in the same line of business, so same explanation will come into picture. So I'm going to refer that it is, everything is same. Okay, but last, here I'll tell you in brief. A telecommunication company will give to the power supply company some talk time. How much it will give? Telecommunication company will give 1 lakh minutes, free minutes. they are free minutes actually, 1 lakh, and generally the standalone price for the number of minutes will be 0.5 rupees per minute. And what the power supply company is going giving in exchange for that, it is giving 20,000 units, okay, which is 2.5 rupees per unit. So I need to discuss you the last point on the basis of that. The last point, that is, on the basis of this above, basis of that, revenue that is recognized by A Limited will be the consideration in the form of power units that it expects to be entitled for the talk time sold. That is, how much A Limited will recognize? 50,000, that is 20,000 into 2.5 rupees. Next, the revenue recognized by B Limited will be the consideration in the form of talk time that it expects to be entitled for the power units sold. That is 50,000, that is 1 lakh minutes into 0.5 rupees per minute. That's what I could say. This is also easy. And next question, number 26. In this, MS Limited is a manufacturer of cars. What the MS Limited do? It manufactures the cars. Apart from that, it has a supply steering system as well. That is SK Limited. Now MS Limited places an order. Who is a manufacturer of cars? They went ahead and they ordered 10,000 steering systems to SK Limited. Now it also agrees to pay. It is also agreeing to pay 25,000 per steering, right? Steering system, and contributes the tooling to be used in. Sorry, yeah, it is also contributing the tooling as well, and that tooling has a fair value of 2 crores at the inception of the contract, beginning of the contract. Now, SK Limited is also determining that each steering system represents a single performance obligation. One steering system is equals to one performance obligation that has a control of steering. Excuse me, that have a control of steering system. Control of the steering system transfers to the to MS Limited upon delivery. So here SK Limited may use a tooling for other projects also, and it also determines that it obtains the control of the tooling. Next, what is the answer for this? How you will determine the transaction price? Here, as a result, what happened at the contract inception, at the beginning of the contract, whatever SK Limited is there, SK Limited will include the fair value of the total of the transactions of total in the transaction price at the contract inception. So, which it determines to be 2.27 crores. That is 25 crores steering system plus 2 crores for tooling. Because here SK Limited, hmm, fair value of the tooling in the contract price at the contract inception, which it decreases, I mean, which it determines to be how much? Fair value plus tooling cost, 25 plus 2 crore, 25 crore plus 2 crore for tooling. 2 crore is for tooling. That's it. Yeah. Next question is 27. Goes like this. How? An entity that manufactures a customer's goods. Entity is manufacturing the customer goods. That is the first point. Okay. Next, entity that manufactures the customer goods, consumer goods. Now here they enter into a contract. An entity will enter into 1 year contract with large global chain of retail stores. Here the customer commits to buy at less. How much in demand? Let's say it's a global retail stores only. No, DMart is also one of the example. So here the customer has committed to buy at least 15 crore of products during the year. So here the contract also requires the entity to make a non-refundable payment of 1.5 crore. So this 1.5 crore is not refunded. In the 15th crore, I think you need to subtract. See, the answer goes like this. What is the transaction price? Here, the entity entity will consider. The entity considers the requirements in Ind AS 70 and in days 117. Sorry, in para we are not learning, so you have to check the requirements of Ind AS 115, revenue from contracts with customers, and concludes that the payment to the customer is not a exchange for the distinct good, or service that transfers to the entity, that transfers to the customer shells. Now here, consequently, you can say that the entity determines that in accordance with Index 115, that is revenue from contract with customers, 1.5 crore will be the reduction in the transaction price, because here whatever 1.5 crore is there, it is an investment activity if I'm not wrong. Payment will compensate the customer. Okay, it will compensate 1.5 crore will payment of 1.5 crore to the customer you need to pay, who is taking the shelf. Here the entity applies the requirements of Ind AS 115, and it is also concluding that the consideration that is payable is accorded for the is accounted for as a reduction in the transaction price. Okay, when the entity reduction in the transaction price, when the entity recognizes the revenue for the transfer of goods. Consequently, you can say that as the entity is transferring the goods to the customer, the entity reduces the price that is taken for each good by 10%. Okay. Also, during the first month, you can say that in which the entity transfers the customer, in which the entity transfers goods or service to the customer, the entity recognizes the revenue of how much? 1.125. How did you get this? It's generally 1.25 crore minus 0.125. Then how did you get it? See, 15 lakhs in 15 lakhs minus this 15 lakhs minus 1.5 crore deposit divided by 12 months. You do. Then you'll definitely get 1.125 crore. Okay, that is the amount that is payable. Right. Next, question number 28. Here you have a set of questions. Generally, let me say in next question in question number 28. Okay, entity I sells a piece of machinery. It sells a piece of machinery to the customer for 2 million. It's like 20 lakhs. Okay, that is payable in 90 days. So entity I is aware at contract inception, at the beginning of the contract, that the customer might not pay the full contract price. So the entity I estimates that the customer will pay at least 1.75 million, which is sufficient to cover entity I's presence in this market, which is sufficient to cover entities I present in the market. So now entity I has granted the similar price concessions in comparable contracts as well. Okay, now entity I, what they estimate, question says that it estimates that the customer will pay at least 1.75 million, 17.5 lakhs he'll pay, which is sufficient to cover the contract cost of sales, that is 15 lakhs, right? So you have to check that. So see, he's asking the transaction price. What is the transaction price? So anything less than what is expected, yes, you are able to receive. That is a transaction price. See here, entity I is likely to provide a price concession and accept an amount less than 20 lakhs, like which is 17 point like 1.75 million. Okay, he is supposed to receive 2 million in exchange for a machinery, but here the consideration is therefore variable, and the transaction price is in this arrangement is 1.75 million. So as this is the amount which the entity expects, which entity I expects to receive after providing the concession, and it is not constrained under the variable concession guidance. So entity I can also use can also conclude that what the collectability threshold. What can it conclude? The collectability threshold is met for 1.75 million only, and therefore the contract exists. So this is 78. And in that, the other question is on 1st January 2018, entity I entered into a 1 year contract with the customer. How much? 1 year contract with the customer to deliver water treatment chemicals. Okay, then the contract also stipulates that the price per rubber will be adjusted retrospectively from the beginning. The price will be adjusted. When it will be adjusted? When the customer reaches a certain sales volume defined as follows. Like if a customer reaches one, if the customer reaches to one container, excuse me, one container to 10 lakh containers. Okay. If the customer reaches one container to 10 lakh containers, then the price per container will be 100 rupees. If 10 lakh containers to 30 lakh containers, it will be 90 rupees. If 30 lakh containers and above, it will be 85 rupees. Price per container. In that way, the container will have the concession. That is retrospectively from the beginning. Now here, volume is determined based on the sales during the calendar year. There are no minimum purchase requirements. So here, volume whatever is there, this is only during the calendar year. There are no minimum purchase requirements. So entity Y estimates that the total sales value will be, it might be 2.8 million. 2.8 million containers might be the volume. Now, based on the experience, it was similar. Based on the experience with similar contracts and forecasted sales to the customer, entity Y sells 7 lakh containers to the customer during the first quarter, ended 31st March 2018, for the contract price of 100 rupees. So here, based on the 2.8, it thought it will cross 2.8. It should be 90 rupees because it is between 10 lakhs to 30 lakhs. But what here is entity J did? Entity J sold this 7 lakh containers to the customer during the first quarter, during 31st March 2018, for a contract price of 100 rupees per container. So it sold at 100 rupees, but it is only liable for 90. Now, how the entity should estimate this transaction price? Now, see, the transaction price is 90 rupees per container. How did you get that? Generally, what the how is the answer? It goes like this: the transaction price is 90 rupees per container. What is the transaction price? 90 rupees per container based on the entity's J estimate of the total sales volume for the year. Since the estimated cumulated sales volume is, and I mean, it is like total cumulated volume is 2.8 million, which is between 1 million and 3 million, which is 2.8 million. Should the containers would result in a price of how much? 90 rupees. Entity J concludes that based on the transaction price of 90 rupees, container based on this transaction price of 90 rupees per container, it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not occur when the uncertainty is resolved, and the revenue is therefore recognized as selling price. Therefore, and the revenue is therefore recognized at a selling price of 90 rupees per container. Okay. As such, the container is sold, as in when the container is sold, it is um, recognized at selling price of 90 rupees per container at each container, as each container is sold. So your entity J will recognize a liability for how much? 100 rupees per container. It will recognize 100, sorry, 10. I think here liability will be, see, revenue will be recognized for selling price of 90 rupees. Okay. And liability will be 100 minus 90. That is 10 rupees per container. Simple. And revenue will be 100 minus 90. That is 10 rupees per container. For the first 1 million containers sold at 100 rupees per container. Why? Until the cumulative sales occurred. Like until the cumulative sales volume is reached for the next pricing tier and the price is retrospectively reduced. So for the quarter ended 31st March 2018, entity J recognizes the revenue of 63 million. That is 7 lakhs for the first 7 lakhs into 100. You can say it is 7 lakhs into 90 or 7 lakhs into 100 minus that 7 lakhs into 10, or directly 7 lakhs into 90, it will be 63 million, and the liability will be 7 million because it is 7 lakhs into 10. Okay, that is 7 million. So the entity J will have to update its estimate of total sales volume at each reporting date until the uncertainty is resolved. So it's like that. Now, next question goes like this. Entity K sells its electric razors, okay, to the retailers for 50 rupees per unit. Okay, one electric razor is 50 rupees per unit. Here, the rebate coupon is included inside the electric razor package that can be redeemed by the end customers. It can be redeemed by the end customers for 10 rupees per unit. Also, here, entity K estimates that 20% to 25% of the eligible rebates will be redeemed. So, based on the experience with the similar programs and rebate redemption rates that is available in the market for similar programs, so what K concludes, entity K concluded that the transaction price should incorporate an assumption of what? It could incorporate, K concludes that the transaction price should incorporate an assumption of 25% rebate redemption as at the amount of at this amount, yeah, generally, yeah. Here entity K is selling what? Electric razors, okay, to the retailer C for 50 rupees, and here he is also redeeming a coupon for each 50 rupees, that is 10 rupees per unit. And the entity K is also estimating that 20 to 25% of the eligible rebates will be redeemed. Here the rebate is 10 rupees. Let's say 10 rupees per unit. Now only 20 to 25% will be eligible for will rebate, will redeem this based on its experience with the similar programs, based on their experience with the similar programs and rebate redemption rates that is available in the market for the similar programs. So here entity K also concludes that the transaction price should incorporate an assumption of 25% rebate redemption. So, as this is the amount for which it is highly probable that a significant reversal of cumulative revenue will not occur if the estimate of the rebates change. So, how should entity K determine the transaction price? How should it determine? Now, entity K should record the sales to the retailer. See, let's see how the entity K should record the sales. Here, entity K records the sales to the retailer at a transaction price of 47.5 rupees. That is only, most probably it is like 25% rebate redemption will be done. So 10 rupees into 25. Okay, 10 rupees into 25% will be done here. So out of the 50 rupees in total, what razor, electric razor, 50 rupees minus, out of this 50, what happened? 50 minus, it is rebate, that is 10 rupees rebate, only 25% redemption will be done. So you are subtracting from the total revenue. So the difference between per unit cash selling price to the retailers, and the transaction price will be recorded as a liability for the cash consideration that is expected to be paid to the end customer. Here, entity K will update its estimate of rebate. That is however, what the rebate is claimed, and the transaction price at end of each reporting date if the estimate of redemption changes. Next question is like this: the manufacturer will enter into a contract. Manufacturer enter into a contract to sell the goods to the retailer for 1,000 rupees. Here, the manufacturer also offers the price protection, whereby it will reimburse the retailer for any difference between the sale price. Who will reimburse? Manufacturer will reimburse the retailer the difference between the sale price and the lowest price that is offered to any customer during the following 6 months. So this clause is consistent in next 6 months if he is making any sales. Okay, if he is making any sales which are, I mean, where the difference between the sale price and the lowest price offered to the customer is less than 1,000, then he will reimburse back. Okay, so this clause is consistent with the other price protection clauses that were offered in the past. Then the manufacturer is also believing that it has an experience which is predictive for this contract. So management is expecting that it will offer a price decrease of 5%. It is offering a price decrease of 5% during the price protection period, and also 5%. So 1,000 mine into 5% is 50 rupees will be the price protection. And here, what is the transaction price? Here he is asking the transaction, what is the transaction price? So it can be 950 will be the transaction price that can be recognized as a revenue. Let's see, here the transaction price is 950 because the expected reimbursement is 50, that is 5% of 1,000. You see, the expected payment to the retailer is reflected in the transaction price at contract inception, as that is the amount of consideration to which the manufacturer expects to be entitled after the price protection. Also, the manufacturer will recognize a liability for the difference between the invoice price. See, liability will also be recognized between 1,000 rupees and 950 rupees. That is, 50 rupees of liability will be recognized. Okay, and this represents the cash that it expects to refund to the retailer. And here, as it is refundable, it will be a liability. The manufacturer will update its estimate of expected reimbursement at each reporting date until the uncertainty is resolved. Next, 29th question, it is a commercial plane. There is a commercial plane component supplier who enters into a contract with the customer. Okay, for what? Here, commercial plane component supplier, he entered into a contract with the customer for 70 lakhs. So based on that evaluation of facts and circumstances, here the supplier concluded that 1,40,000 represented a insignificant. So whatever the 1,40,000 is there, it is an insignificant financing component because of the advance payment that is received in excess of the year before the transfer of control of the product. So state whether the company needs to make any adjustment in determining the transaction price, whether the company needs to make any adjustment. Yes. What if the advance payment was larger and received further in advance, such that the entity concluded that 14 lakhs, 1,40,000, it is considering insignificant financing amount. So let's say it is 14 lakhs that represents the financing component, whether it is representing a financing component or not, he is asking. So first say here whether this 1,40,000 or 14 lakhs represents a finance component or not, it is just based on the judgment. It is based on the judgment of that particular entity or a manufacturer in this case. Okay, in this case, commercial airplane component, for that 1.4 lakh is not significant. See, 1.4 lakh is 2% of 70 lakhs. So whatever 2% is there, it is not significant, may not be concluded as significant for the commercial airplane component. Whereas 14 lakhs, whatever is there, 14 lakhs into 20% of 70 lakhs, okay, that is financing component, may be concluded as a significant one. So the entity may conclude 1,40,000 or 2% of the contract price 1,40,000 is 2% of the contract price is not significant, not much significant, and that the entity may not need to adjust the consideration that is promised in determining the transaction price because it is insignificant. Now, however, when the advance payment was larger and received further in advance, such that the entity may conclude 14 lakhs, whatever is there, it represents the financing component that is based on an analysis of the facts and circumstances. So, in such a case, an entity may conclude that 14 lakhs or 20% of the contract price is significant, and the entity should adjust the transaction promised in determining the transaction price. So, the entity should adjust the consideration promise, that is 14 lakhs into 20%. As it is considering it is significant, it have to adjust the consideration promised in the, see here, it have to adjust the consideration promised in the in determining the transaction price. So in this question also, the entity's conclusion that 2% of the transaction price was not significant and 20% was significant is a judgment that is based on entity's facts and circumstances. The entity may reach a different conclusion based on the different facts. Next question is 30th. NKT Limited is selling a product to the customer for 1,21,000, that is payable 24 months after delivery. How many months after delivery? 24 months. So you can say there is a significant financing component because the period is more than 1 year, see 24 months. Here the customer obtains a control of that product at the contract inception itself, and the contract permits the customer to return the product within 90 days. That is return back period. Now here the product is new. Here the product is new and the entity has no relevant historical evidence of the product returns or other available market evidence. So here the cash selling price of the product is 1 lakh, which represents the amount that the customer would pay upon delivery for the same product sold under otherwise identical terms and conditions of the contract inception. So here the entity's cost of product is 80,000. The contract includes an implicit interest rate of 10%. That is 10% is included in the contract itself. So you can say here 1 lakh is the cash selling price and 1,21,000 is the price at which he sells to the customer. So can you say 21,000 is a significant financing component? See here, he is asking that only. The contract includes an implicit interest rate of 10%. Okay, the interest rate of that is over 24 months, that over 24-month discount, the component here, the promise consideration is 1,21,000 to the cash selling price of 1 lakh, that is 21,000. Analyze the transaction above with respect to its financing component. That's what he is asking. So the answer will be like this. The contract includes a significant financing component. You can say that. Why? This is evident from the difference between the amount of the promised consideration of 1,21,000 and the cash selling price of 1 lakh at the time the goods are transferred. Here, the contract includes an implicit interest rate of 10%. That is the interest rate that over 24 months discount, that over 24 months discount, I mean any interest rate that is over 24 months, over that 24 months, it is discounting the promised consideration of 1,21,000. That is an implicit rate. See, 1,21,000, if you discount it for 24 months, you get 1 lakh. The entity evaluates that the rate, the entity is evaluating the 10% rate, and it is concluding that it is commensurate with the rate that would be reflected in a separate financing agreement between the entity and the customer. If there is a separate financing agreement, that would be the rate. Okay. Now, until the entity receives the cash payment from the customer, now here the interest revenue would be recognized in accordance with Ind AS 109. In determining the effective rate, interest rate, in accordance with Ind AS 109, the entity would consider the remaining contractual term. So this is like that. Next question. So we'll do it in next video. Next question. Okay. So okay, share it with your friends if you find it useful. Make sure that you are revising this whenever you find time, and thank you. I don't ask you to subscribe or do something, but it's like if you do it, you will get a notification whenever you know, even though you are not into YouTube, because We won't will generally be in studies, okay, in all this precious 3 months. So I don't think you need to waste your time by checking out videos. So make sure that you get subscribed. Also, if you don't want it to, no problem, not an issue, I'm not forcing anyone. Thank you.